Good day, ladies and gentlemen, and welcome to the show. On this Sunday the 7th of March, 2021. Thank you for tuning in. Now, I'm going to tell you guys, going back months ago, I was telling you guys about an economic recovery. Couldn't see it back then. An awful lot of these stations that you watch on YouTube and stuff, other ones, we're talking about an 80% stock market crash, 90% stock market crash, and that's definitely going into a next Great Depression, worse than you ever seen. Now, there's a big difference between an economic recovery and going into a Great Depression. Well, we see the seeds of the economic recovery beginning. More and more states are opening up. I think it's 17 states right now are opening up for business. As usual. You know what? Your local pizza place. A lot of the pizza places probably closed up. Well, I'll tell you what you're going to see. People get out, get around. They want to get something done. They've been locked up for ages. You're going to see big long lineups like at your local pizza place because all the other ones closed. Maybe half of the pizza places around you closed up. Big long lineups. You see the price of pizza go up because that pizza place is doing more business than they know what to do with. They're going to jack the price of their pizza up. Maybe you used to be able to buy a large pizza for $20, an 18-inch pizza. Now the price is going to go up to 24, this is what you're going to see. And then you're going to see other people come in and look at these big long lineups, and they can't make enough pizzas, and they're going to say, that pizza place over there closed up. They still got the ovens and everything else. Sign on the door says closed, lease, rent, Another guy will spot that, a new owner. Suddenly you'll see a second pizza place open up. You'll need people to hire on, right? This is what's going to happen. This is the recovery I was telling you guys about. The seeds of it are starting right now. Now, it's not going to be a super recovery. We're not going to go back to 2019 highs when everything was perking along and the economy was like red hot. But you know how depressed everything is right now? It's going to start to pick up a little bit from that depression. It's going to start to move up, right? And now we got $1.9 trillion stimulus package was passed through the Senate. Just now, your checks are going to be in the mail pretty soon. I think they're $1,400 checks, but they're going to be in the mail, right? This is going to help stimulate it even more because people are going to have money in their pockets. Now, what happens when you open up a whole bunch of states and more to come, and you got people out there with a lot of money in their pocket? What happens? Okay? This is what we see happening. And people that have had to stay at home for ages, the only thing they could buy is things on Amazon. Now they get out there, they're going to shop. They got $1,400 in their pocket, seriously, guys, we're going to see a little bit of a pickup, and it's starting now, right? And it's going to progress later into the year, This year, Christmas is going to be so much better than last Christmas, guys. This year. As the economy picks up all this, but what's it going to do? And, we got other problems I got to talk about, and I got to get to, other big problems in the next month. It's got to do with something called the SLR, okay? Let me take a look at this. It says U.S. banks are pressing the Federal Reserve to extend concessions that were loosened as far as capital requirements are concerned when the pandemic struck. They're arguing that the financial markets would be at risk if the relief expires as planned on the 31st of this month. So the 1st of April. You got to watch that date, guys. The 1st of April. Because if the Fed doesn't extend these concessions that they gave to the banks are going to sell off an awful lot of assets on their books. They're going to pare their assets back that they're holding on their books, the banks are. But at the same time, we got this $1.9 trillion stimulus coming in, which is working in the opposite direction of that. So one's going to force down, the other one's forcing up. Um, Also, something else to talk about. The Fed and the Treasury, they're talking about the now. This is just in the talking stage right now, but they're talking about doing it, and that's how things start. They start in the talking stage, and then later they do it. The Treasury is talking about spending their general account at the Fed, their account with the Fed. Uh, it's $1.6 trillion, and how they're going to do this is they're not going to renew the Treasury bills. They're not going to roll them over. What they're going to do is they're going to make a cash settlement on these Treasury bills. So it's going to be a direct cash injection, basically, of $1.6 trillion more. And I think this is on top of the 1.9 trillion. So, I'm going to tell you that the Fed, with all that money poured into the system, the markets are going to start to overheat between now and the end of the month. They might be thinking to themselves, hey, you know what? Let's not let these markets overheat too much. Let's cool them down a little bit by not extending the SLR and let the banks sell off a little bit. So what we might see is we might see the markets move upwards quite a little bit between now and the end of the month. And then 1st of April, April 1st, joke time, boom, the Fed doesn't extend the SLR. And, this could cause a sharp uh, deflate of the markets in the first part of April, for maybe the first week of April. Maybe 5-10%, considering. Now, normally this would probably knock 25% off of the markets. But you got to understand it would be happening in an atmosphere where they're bringing in money from two different angles, from $1.9 trillion stimulus package and a $1.6 trillion general account that the Fed holds with the Treasury, their general account. So you got money pouring in, with two big money chutes pouring into the system at the same time that the banks are selling. One might kind of bandage over the other. Maybe this is what the Fed's thinking, and they're not really making any announcements on what they're going to do just yet. I don't think they want to actually affect the markets. So they're kind of keeping mum on it, whether they're going to extend this SLR. So we got a lot happening, and there's going to be a lot happening at the end of this month. When we move into the first day of April, we're going to have to wait and see what happens with this SLR. If they decide to extend the SLR into the future, why, the markets are really going to take off. But if they don't, then that might cool the markets down something. I'm thinking to myself, with one pouring in from the other side, one pouring in from the other, that normally what would be a 25% might turn into more like a 5% correction. So we might see, if they don't extend it, we might see like a 5 to 10% correction in the markets in the first week of April. Now, what about the treasuries overheating on the long end of the yield curve, which they have been doing, and it's been causing problems in the market? Well, they have something that they can use called Operation Twist. And they've done it before, where they take the short-term treasury bills that they hold, and they sell them off and use it to buy they twist it, and they use to buy long-term maturity treasuries, and they're holding, excuse me, they're holding right now more than $1 trillion worth of these short-term maturity treasury bills. The Fed is, that they can use to buy long-term treasury bills. And so by doing this, they can bring down that yield curve on the long end of the yield curve. They can twist. It's called Operation Twist, guys. And they can bring down that long end, back down into a more suitable range, because the U.S. 10-year is starting to push up toward 2%. They let that thing go over 2%. What we're looking at here is the real estate market. There's a lot of markets that depend on that U.S. 10-year Treasury note and how much it is. Okay? And so I can see them controlling that. So now we got that out of the way. Let's talk about what'll happen if the economy starts to do like, we start to get this tepid recovery. I'm not going to call it a super recovery. I'm going to call it kind of tepid. What will happen? What's going to happen is this is going to lead definitely toward inflation. It's going to lead heavily toward inflation. We already see the seeds of inflation. We got that $1.9 trillion pouring into the economy. We're going to see prices go up massively, and the reason why is as we move toward into this recovery and things start to pick up, that has a direct effect upon the velocity of money. So all year this year, what you're going to see is prices increasing on everything, heading toward December this year, and the economy starting to pick back up and become normalized again. Guys, it's going to feel good because you're probably going to be able to get out, go to your favorite restaurant or whatever, and there's going to be new jobs coming in. A lot of people are going to be getting work again, and everything. And everything's going to look rosy heading toward December. Probably going to have a great Christmas. We move into next year, probably the first 3 months of next year, you're going to notice this inflation become more and more, and that's when, you're going to see your gold and silver and cryptocurrencies are going to be moving up. This whole time, from here forward, I think we're moving into the real meat part. We're going to start moving into the real meat part of the bull run. The deflation's going to start to get left behind. We're in a horse race right here. Deflation on one side, on the right side, and hyperinflation on the left side, and they're like two cars racing down the track, And they've been head to head. It's been a tie race. Now inflation's going to start to pull away, and it's going to leave the deflation in the dust. It's going to hit the afterburners. Right now is when it's going to hit the afterburners, guys. And and when everybody sees, like, this has been a race, and you got a lot of people watching the race, and they're saying, hey, deflation's got a good chance here. It's going to win. It's going to win. And all of a sudden, when those afterburners hit, and the guys have been betting on that car, they got their ticket, and I'm going to win the race, I'm going to win the race, and I'm going to have a lot of money because and when they see the afterburners hitting that hyperinflation take off and leave the deflation in the dust, they're going to be tearing up their ticket, oh no, I lost the race, oh, my money's gone. But for the guys that bet on inflation, the guys who stack silver, the guys who stack gold, the guys who stack cryptocurrencies, they're going to be like, yeah, I won! When they see those afterburners hit. The afterburners are probably going to kick in. It's going to kick in. All this money. You can't not have the afterburners. This is the afterburners. You know how much money $1.9 trillion is? And then them dumping in, how much was it? Let me just take a look here. Another 1.6 trillion from the Treasury General account. Between the two, that's what, 1.9 and 1.6. We're it's money galore. It's like over $3 trillion. Almost $4 trillion. It's money galore. Of course, that's gonna, and then the economy picks up at the same time. Goodbye deflation. That's nitrous oxide. He's got a nitrous oxide in that thing. He's gonna zoom, and the deflation's gonna be sitting there and what happened? Goodbye deflation. But, you know, expect to see these prices go up massively on everything. And then it's going to be clear and obvious to the whole world. The dollar's sinking. And then everybody's going to start spending them suckers. You know, so what's going to happen is the first quarter moving into 2022, and the second quarter, the inflation's going to be heating up like crazy. And then by the end of 2022, we're going to be in it. Everybody's going to be spending that money as fast as they can get it. And I can't tell you guys how high. You don't need very much. Stuff like gold, silver, crypto, you're not going to need very much. Really. If your neighbor's got none, and he's all in dollars, he's going to be hurting bad. He's going to be hurting bad. And you don't need very much gold, because it can go to infinity. I mean, let me ask you guys. If one guy's got a gold coin, and the other guy's got a wheelbarrow full. Listen, back in Germany, one woman went in to buy a loaf of bread, okay, during the German hyperinflation. And she filled her wheelbarrow with Deutschmarks. And she parked it outside the store or whatever. You know, and she took all these. They didn't steal the Deutschmarks. They dumped them all over the ground. They stole her wheelbarrow. It was a wheelbarrow full of money. They stole the wheelbarrow, left the money. This is what can happen to the United States dollar. I know it sounds unbelievable, but it's happened over and over and over again through history. And it's not unbelievable. It can actually happen. So people that believe it can't possibly happen, you better get your head out of the sand, because we're moving toward it so fast, and I don't see any other way that can go with them dumping all this money into the system. You just can't dump trillions and trillions and trillions and trillions of dollars and expect prices to remain normal. And once the inflation starts to hit, people start to lose confidence worldwide. And that can happen pretty fast. Guys, so you're right now, it's just a strange little thing, you know, right now. Like, what's happened is that silver and gold prices went down. Like, it's making it, silver right now has never been cheaper. Gold has never been cheaper, guys, than it is right now, priced in these dollars that we got. Never been cheaper in history. They've knocked it down so low. I can't think of any time, comparatively speaking. I know the price is higher than it used to be, like in the 1930s. You know, the price was $35 for an ounce of gold. You know, but I know the price is a lot higher right now. But those dollars were worth a heck of a lot more. People used to work for $40 a week back then. You know, what's the dollar worth now? It's worth tiddlywinks. You know, I remember a time when I was younger, you know, kids would reach down to pick up a penny if they saw a penny in the parking lot. Now a kid can walk by a quarter and he won't even reach over to pick it up. Our money's becoming totally worthless. It's been a long time. It's been a long-term process, reaching the final conclusion. But we're getting there, and we're getting there now. And listen, thank you guys for listening to my show on this Sunday. Appreciate my audience out there. You guys have a great rest of the weekend. Go suck some hot dogs down or whatever on the barbecue. And we'll catch you guys Monday morning. Bye-bye.